In this video we are going to study a very common problem in trading regarding risk and time. As many of you already know, trading is supposed to be a long-term endeavor. If you don't think that's the case, you should ask yourself if trading only for the short term is worth the effort. The issue is that there are certain things that only happen in the short term, and certain things that only happen in the long term. The problem of professional trading in some sense is that it is possible to make money really fast in the short term. However, traders who attempt to do this usually forget the iron law that for high returns there must be high risk. There is no way around that. In other words, to make high returns on your capital in a short amount of time, it is absolutely critical that high risk is taken. This is one of those universal laws that work a lot better if you give it the due respect. When traders learn how to make money in the short term, they usually forget about this whole situation regarding the tight relationship between risk, time, and return. That's a huge problem because there are other iron laws that must be respected. For example, even though it is possible to make money quickly in the short term, it is very unlikely that you will continue to make money at that rate in the long term. This seems obvious, but a lot of people ignore it. If you are in a high-risk approach, every time you take a trade you are risking most of your capital. This exercise eventually fails no matter how good the trader. It actually has nothing to do with ability. It has to do with the fact that high-risk trading is unsustainable in the long term. There are times when the market is easy to trade and everything flows very well, but there are times when the storm comes. Imagine what happens when you have a high-risk approach to the market and all of a sudden it stops flowing smoothly. Since that sort of thing is entirely unpredictable and is guaranteed to happen, you will eventually jeopardize your entire capital because you simply want to make money quickly. The irony of the high-risk approach is that it will catapult you to the starting point eventually. In other words, in the rush to make money too quickly, you will only waste your time, which is the exact opposite of the intended goal of optimizing your time. On the other hand, if traders would consider the effect of propagating the iterations of their trading approach in the long term, they would have no choice about choosing low-risk trading, which is not only a wiser approach, but it is the only approach that survives in the long term. Don't get confused here because low-risk trading is still pretty fast compared to other types of businesses in terms of return on investment. We can derive a few conclusions from this. High-risk trading is a negative feedback loop or a self-correcting pattern. In other words, every time that a trader attempts to bend reality by sustaining a high-risk approach in the long term, reality will snap the trader right back where it belongs, which is in the starting point. You would imagine that most traders learn the lesson when this happens for the first time, but that's not what happens at all. What happens is that the trader assumes he was doing something right in order to obtain such a high return in such a short amount of time, so he concludes that bad luck was the actual reason that made him go back to the starting point. The problem is that we cannot control our luck. That's like living inside a cage with a lion and hoping it won't wake up to eat you. Eventually the lion will wake up. Traders make up all sorts of excuses to justify this sort of behavior, but the reality is only one. High-risk trading is not sustainable in the long term. It is only doable in a very short amount of time, so there is no point even starting it. The low-risk approach on the other hand is indeed sustainable in the long term, and ironically it can yield much more money than the high-risk approach. The only issue is that it is not so exciting as the high-risk approach, but you have to remember that your goal is not to be in an emotional roller coaster. It's making money consistently. Low-risk trading is a self-reinforcing pattern or what we would call a positive feedback loop. In other words, the longer you stay in this game, the more money you will make. Remember that what we are calling low-risk trading here is still pretty fast if you think about it. For example, let's say you have $100 to start trading, and you can get a 20% return on investment every month. If you compound that for 5 years you will get almost $4.7 million in the end. If you spend 5 years in the high-risk trading approach, at the end of 5 years you will be still trying to transform $100 in $20,000 in a month, not to mention the stress of not being able to do it for 5 years. In trading you have to outsmart your wishes and biases. If you are capable of doing that you will certainly achieve your goals. If you want to learn how professional traders think, don't forget to check the pro trading video courses available in the strategy store in the video description. If you enjoyed the video and wish to support the channel, don't forget to click the like button, subscribe to the channel and to leave your comment below. Thank you for watching.